Federal student loan payments are set to resume for nearly 44 million Americans, and the anticipation is causing financial unease across the nation. As the looming monthly bills threaten to reshape spending habits and financial security, surveys conducted in the lead-up to the end of a 3.5-year payment pause have unveiled a sense of apprehension. Multiple recent surveys highlight the concerns of borrowers. Around 75% of them plan to reduce their spending, according to the MassMutual Consumer Spending and Saving Index. Similarly, the same percentage fear difficulties in saving for retirement once student loan payments recommence, marking a concerning shift from the savings patterns of the past few years. Interestingly, a survey from Bankrate reveals that 24% of Americans with student loan debt view it as their most significant financial regret. Meanwhile, stress levels among borrowers have risen for 57% of them over the past year, as the first due date since early 2020 approaches. These findings align with other surveys that suggest some borrowers will struggle to meet their obligations. Experts have been sounding the alarm about the impending student loan cliff, warning that once the monthly payments are back, consumer spending may decrease. Household budgets already strained by inflation and historically high interest rates may find it challenging to absorb the additional monthly expenses, potentially leading to a drop in consumer spending. A potential consequence of this situation is a significant reduction in U.S. consumer spending, which could amount to as much as $9 billion per month, according to a report by Oxford Economics. This, in turn, could lead to a 0.1% decrease in gross domestic product growth in 2023 and a 0.3% decrease in 2024, heightening the risk of a recession. It's not just the loans themselves that will cause strain for households. Many consumers with student debt took on additional financial obligations over the payment pause, like home and auto loans or credit cards. That means their overall debt has increased over the past 3.5 years, particularly for borrowers who were already in financial distress prior to the pandemic, says Liz Pagel, Senior Vice President of Consumer Lending at TransUnion. However, while some households, especially those with lower incomes, may feel financially stretched, others, particularly middle and upper income households, may dip into their savings to manage the resumed student loan payments, according to Oxford Economics. Borrowers have already begun making payments in advance, possibly to reduce the principal amount before interest starts accruing significantly once again. In recent weeks, borrowers repaid over $2 billion and even set a record with $3.6 billion in repayments during 1 week, as reported by Treasury receipts from the U.S. Department of Education analyzed by Hever Analytics. In contrast, payments for the same period last year were closer to $400 million. The payment pause has allowed many households to achieve various financial goals, such as purchasing homes, paying off other consumer debt, or coping with rising essential costs. Reintroducing the student loan bills threatens to erode these gains. Even higher-earning households are not immune to the financial squeeze, with 71% of those earning at least $100,000 expressing expectations of missing at least one payment when payments resume, according to Morning Consult. For those unable to afford their payments, there are options available. They can enroll in income-based repayment plans like the new Save Plan, which calculates payments based on household size and income, potentially reducing the monthly bill. As a last resort, borrowers can skip payments for the next year without facing the usual negative consequences, thanks to a 12-month grace period announced by the Biden administration. Although interest will accrue, it won't capitalize, though it's worth noting that credit scores could still be affected.